Y en ese entorno saludamos a Jay Pelosky, as founder and principal of TPW Advisory. Jay, thank you so much for having us a few minutes.
Thank you. Nice to be with you again.
Jay, on Wednesday we will get inflation data for June. Markets expect CPI to climb to 8.8%. However, these days we've had big surprises in final data respect estimates. For example, that's what we had in the payrolls data last week on Friday. Do you believe we could get a big surprise on CPI this Wednesday?
Yes, I think that the CPI print is going to be important to markets. It's very interesting to note the recent rally in bonds, particularly at the long end, suggesting that concerns about inflation have become less important to the markets than concerns about recession. And then, of course, we had the jobs number on Friday suggesting that it's unlikely that the U.S. is in recession when it's creating 350,000 odd jobs a month. And the hourly earnings number was also kind of supportive for declining inflation, which I think further gives investors confidence that inflation is gradually being brought under control. But certainly the print on Wednesday, as you pointed out, 8.8% is the consensus, extremely high, ahistorical, and probably means the Fed is going to raise rates by 75 basis points at the end of the month when it meets next.
Meanwhile, Yale earnings season begins this week. What can we expect from one hand, because these earnings are those of the second quarter, the moment we saw the biggest impact from Russia's invasion of Ukraine. Should we expect bad numbers?
Yes, I think you're right to focus on the earnings outlook. I mean, ultimately, that's what drives stock prices. And there's a great deal of debate right now, as there's so many things about the earnings outlook. A number of Wall Street strategists are expecting poor earnings and are talking about earnings coming in 10 to 15% below current consensus. And that's the explanation for what's going to take the stock market down another 10 or 15%. If earnings are fine, then it's hard to make the case for stocks to go down much further, given that we've already had a very significant valuation derating, and the S&P now trades below both its 5-year and 10-year average valuation, down 20% year to date. My own view is that earnings are going to be fine. We've spoken about this before. Investors are having a hard time understanding the importance of high nominal growth, because for years following the 2008-2009 great financial crisis, we were in a low nominal growth, low real growth environment. Today, it's very different. Nominal growth in the United States is running about 8 to 10% year over year nominal GDP growth. And earnings and revenues are denominated in nominal dollars. And so I think it's likely that with the consensus looking for second quarter earnings to be up 4% year over year, that those numbers will be met quite easily. Then we look at the outlook for the second half of the year and the beginning of the outlook towards 2023. And there, again, as I just mentioned, much of Wall Street expects earnings estimates to come down as the economy slows. I'm not so sure that that's going to happen. Again, high nominal growth means that earnings can be better than expected, given that that nominal growth in the U.S. is probably going to average 6 to 8% for the full year of 2022, and earnings expectations are only for earnings growth of about 7 or 8%.
And Jay, last week was a good week for Wall Street, and one might believe the bear market is over. What do you think about it?
Well, it's hard to say that the bear market is over. What I've been saying recently to clients is that we are in a bottoming process, and a bottoming process entails sentiment, it entails valuation, it entails earnings growth, and it entails technical analysis, particularly when we're in such a ahistorical economic period where forecasters and economists and strategists are all having a very tough time figuring out, where growth is going, where inflation is going, what's going to happen with energy prices. You can see the volatility across assets has been tremendous, and that just suggests that people are confused. And when people get confused, they stop trading, and liquidity dries up, and that exacerbates and makes for even greater price swings, which is, again, what we've seen across all assets. And so I think we're in a bottoming process. The technical analysis is very important in this process. And so when you look at technical analysis, most technicians are saying that we're in a range between 4,100 on the S&P and 3,500 on the downside. So we kind of need to break above that 4,100 level to suggest that we've made a bottom. And so we're in that process. As I said before, if earnings are going to be okay, then it's highly unlikely stocks are going to go down materially from here, materially being another 10 or 15%. If earnings are okay, if inflation comes in and the economy is soft but not in recession, then I think we could expect the market to start discounting when the Fed is going to finish raising rates, and that will probably be the leg that starts us off on a new bull market. So it's a process. It's not a moment in time. We're in that process, and it pays to pay attention to not only the economic fundamentals, earnings, but also technical analysis.
Thank you, Jay. We will pay attention to all of these factors.
Thank
Jay
you very
Pelosky,
much as well.
Founder
Bye-bye.
and principal of TPW Advisory. Thank you so much.